everyone, and welcome back to Girard's monthly market update. I am Vice President and Wealth Advisor Chris Briscoe, and with us today again is Chief Investment Officer Tim Chubb. Thanks for joining, everybody. Tim, to start off, it's hard to believe that it's been over a year since the beginning of this pandemic, but as we trudge through the winter months and head into spring, it does seem like each day things are getting a little better, and we're beginning to see more and more light at the end of the tunnel. And we'll get to COVID and vaccinations in just a little bit, but let's start with the markets, and in particular, the recent market moves. What's been driving some of the volatility of late?
Yeah, I think one of the big, I think questions, or at least concepts that we spend a lot of time discussing with our clients is really the interconnectivity between the economy, interest rates, and the bond market, as well as stocks and equities. And so, when the economy expands and ultimately expectations for higher rates of inflation, hopefully come along with it. That leads the Federal Reserve looking very closely to make sure that they do not necessarily need to tighten monetary policy and put a little cold water on the economy to slow it back down. And the opposite is true also when we're facing a very dire economic situation like we were this time last year. The Fed is going to lower short-term interest rates and ultimately pump a ton of stimulus into the economy like they have in the last two recessions with all the quantitative easing that's taken place. And so, like we've seen in the last 6 months, we've I guess interest rates have moved higher. We've seen nominal yields move higher, but it really hasn't necessarily made too much of an impact in real yields. That is, interest rates after inflation. And so, really, within the last 2 weeks, we've seen real yields rise as investors need to price in higher rates of growth and higher rates of inflation moving forward, which has also been seen in the commodities market with oil and gasoline, as well as lumber prices really starting to move a lot higher, partly due to demand picking up, obviously, as the economy looks like it's going to be normalizing sooner rather than we thought. But also due to the supply chain issues and just the reality that we're still dealing in a COVID world with a supply chain and an economy that's grappled with social distancing. And so, the Fed, it's a bit of a dimmer switch, and as a result, rates need to move in lockstep. And so, the most, I guess, important thing is as good news has come out, has meant bad news as far as the capital markets are concerned, and at least that. We have to price in that good news, which means investors need to be compensated for that interest rate risk in the bond market. They sell bonds, yields move higher, and ultimately that translates into the stock market as well.
Yeah, we talk about inflation, and you flash back 3 months ago, the biggest risk we were discussing was the speed at which the vaccine distribution is going to take place, being that at the time it was the most important catalyst to getting the economy, normalized this year. And on that topic, as we know, the FDA has recently approved a third vaccine, and other pharmaceutical companies are joining in and helping with the distribution. And because of all this, President Biden has announced that he believes the majority of Americans should be fully vaccinated by early summer. Again, good news, potentially great news, and that sheds a little more light at the end of the tunnel. So, Tim, the volatility has caused a backup in yields, that is, a sell-off in the bond market, as yields and prices move inversely as investors digest higher growth and inflation. But why did it cause a sell-off in stocks, particularly growth stocks?
Yeah. And so that's kind of the I guess the last leg of the argument is the economy accelerates, inflation expectations accelerate, investors need to be compensated for that interest rate risk as they maybe not want to own that 3% yielding bond when future rates are going to look like they're 3.5%, and so natural adjustment needs to take place. But in the stock market, fundamental investors like ourselves, we're looking at discounting cash flows, discounting profits over the course of time. And when we discount those future cash flows or those profits, we're trying to basically extrapolate and value a company in the sense that $1 in earnings today is worth more than $1 of earnings in the future. And so as that discount rate moves higher, which in part of that is interest rates, and so where cost of financing is for companies, and ultimately the risk-free rate if we were to not invest in that company at all, but just stuff it into treasuries, for example. Ultimately, those companies, from a valuation perspective, need to adjust a little bit as again, rates move a bit higher, and therefore the discount rate. And so, not to get too technical, but it's the reality of the market and ultimately what has been driving it recently. And I'd say the big thing for growth stocks, in addition to their multiples maybe not looking as attractive as that discount rate goes up, is really the cost of financing. And so if you think about where companies finance their growth, it either comes from the operations of the business, it comes from financing, which could be raising money in the debt and equity markets, or it comes from investing, which would require them selling some assets. And most of these growth stocks have only intangible assets like intellectual property and technology, as opposed to rusty dump trucks and other tangible assets. And so as rates go up, so does their cost of financing, since many of these growth stocks, especially the ones that perform the best within the last 12 months, really don't have a lot of cash from operations being generated, and therefore that means it needs to come from financing, and the cost of financing is going up. And so I'd say it's really that, as well as the just the expectation that investors are not as comfortable paying for a dollar of earnings what they were now that rates are higher than they were before.
Yeah, and it's important to have diversification. It's something that we've been advocating for some time, especially last year, in the past year, and that is a proper balance between cyclical growth and secular growth.
Yeah, no doubt. I think as investors have, I guess, seen growth stocks over the years, and we expect them to perform extremely well as they had in a low rate, low growth environment. They sort of forgotten about value and more cyclical oriented businesses. And so, as we're seeing a cyclical rebound, I think you're watching a lot of investors maybe be a little under positioned in some of those areas. It's been where we've been adding for the last 12 months or so, expecting the economy to get back on its feet this year. And so ultimately, again, it's important to have a bit of a barbell between, secular growth names that are going to benefit from a more digital world, artificial intelligence, 5G, and the like, as well as cyclical growth, which is going to benefit from the economy picking back up steam and people looking to get back on airplanes, and those airplanes needing to have replacement parts. And so it's good to have balance between the two.
And thanks, Tim, for everything you do. And with that said, we're going to wrap up things today. You will see us again next month on Girard's Investment Currents live call, where we will review the first quarter of 2021. We'll discuss the economy and the markets and set the tone for the second quarter and the remainder of the year. Until then, please make sure to visit our website, meetgirard.com. There's a lot of great content on there, and please let us know if you have any questions and if we can assist you in any way. Thanks for joining us today, everyone. Take care, and we'll see you again soon.